Hello everyone, welcome to the final exam review session. My name is Jack and we will be covering chapters 10 through 16 for Professor Jenkins' Accounting 404 final exam today. To start, here's some general studying tips. At the end of each book chapter, there's a page called Questions. This is an extremely good review of all the concepts covered in each chapter and is great prep getting yourself comfortable with conceptual questions that are going to be similar to those you see on the exam. Additionally, I would strongly recommend doing the foundational 15 questions for each chapter of the book. The foundational 15 are comprehensive sets of 15 questions that cover all the bases in a chapter, testing your ability to complete calculations as well as understand the concepts. Finally, I'd recommend redoing all of your homework. The biggest success in Accounting 404 comes from repetition, and McGraw-Hill makes it convenient to check your work and gives you the option to utilize the SmartBook feature to redo homework problems and problems that are similar to your homework problems. As, like I said, repetition is the biggest driver of success in this class. Without further ado, we can start with Chapter 10. Chapter 10, we're going to start with 10-1 and 10-2 conceptual questions. 10-1, what is a quantity standard and what is a price standard? And 10-2, why are separate price and quantity variances computed? I'll give you a couple seconds to pause the video to answer these by yourself. All right, 10-1. A quantity standard indicates how much of an input should be used to make a unit of output. A price standard indicates how much the input should cost. I would know the difference between these two standards, even though these are pretty simple definitions of what they are, quantity standard and price standard. It's important to remember to go back to the basic definition, so that way on the exam, when you see a question that asks you, maybe calculate what the quantity standard is or what the price standard is, you know what you're looking for and you know that it's not going to be too complicated. And 10-2, why are separate price and quantity variances computed? The reason separate price and quantity variances are computed is because separating an overall variance into a price variance and a quantity variance provides more information. In accounting, it's always important to break things down into the detailed view to really get a better understanding of where our numbers are coming from and what we can derive out of our numbers. So separating your total variance into the price variance and quantity variance is just another example of how we break down our information into detailed views in accounting. Moreover, price and quantity variances are usually the responsibilities of different managers. These are good conceptual questions that you may be tested on in the exam. Okay, moving on to exercise 10-6. Huron Company produces a cleaning compound known as Zoom. The direct materials and direct labor standards for 1 unit of Zoom are given below. So we're given the standard quantity and the standard price for each the direct materials and the direct labor. So the standard quantity of direct labor is 4.6 pounds, of direct materials is 4.6 pounds, and the standard price is going to be $2.50 per pound. For direct labor, our standard quantity is 0.2 hours, and our standard price is $18 per hour. Additionally, during the most recent month, the following activity was recorded. 20,000 pounds of material were purchased at a cost of $2.35 per pound. All of the material purchased was used to produce 4,000 units of Zoom, and 750 hours of direct labor time were recorded at a total labor cost of $14,925. So, what are we required to do here? We are required to compute the materials price and quantity variances for the month, and we're also required to compute the labor rate and efficiency variances for the month. So we're going to start with 1 here. We're going to be computing the price variance and the quantity variance for just the direct materials. So how are we going to do that? Here is the work. So the way I like to think about these problems when you're calculating the variances is to make an upside down triangle. So you have the widest bit of your triangle at the top here, and it comes down into the point at the bottom, and then the point at the bottom of your triangle, if your work's laid out in a triangle, is going to be where your answers lie. So starting in the top left here, we need to calculate the actual quantity times the actual price. So we know that they actually used 20,000 pounds of material, and they actually spent $2.35 per pound. So you don't need to worry about any of these standards, just this is what actually happened. So 20,000 pounds times $2.35 per pound, that gives us an actual cost of $47,000. Now in the middle of our triangle here, we're going to be using the actual quantity times the standard price. So we're going to be using that same actual quantity in the first part of 20,000 pounds times the standard price that's given to us in this table. So it's going to be $2.50 per pound is our standard price. So our standard price of 20,000 pounds is going to be 20,000 times 250. So the standard price is going to be $50,000. And we can compare that to our what we actually spent of $47,000. So that's going to give us, when we come down here to the bottom of what I call the triangle, is called our price variance. So the variance is the difference between what we actually spent and how much we estimated to spend using the standard prices. So we estimated $50,000, but it only cost $47,000. Which means there was a variance of $3,000. And this is going to be favorable as we spent less money than what the standard price, the standard total cost would be. So the standard total cost would be $50,000, but we only spent $47,000. So we have a $3,000 favorable variance. Now, coming over to do the quantity variance, the other half of question 1, we have to take our standard quantity times our standard price and compare that to the middle column here where we're using actual quantity times standard price. So to get our standard quantity, we see that it takes 4.6 pounds per unit of direct materials. And we know that all the materials purchased were used to produce 4,000 units of Zoom. So if we produce 4,000 units and the standard quantity is 4.6 pounds of direct materials per unit, that means our total standard quantity is going to be 18,400 pounds. And we get that by multiplying the 4,000 units times the 4.6 standard pounds per unit. Then we multiply that by our standard price given to us in that table, and we get a standard cost of $46,000. So now we can compare that to our middle column here that uses actual quantity times standard price. And we see that it's a difference or variance of $4,000 in materials quantity. And this is going to be unfavorable as the standard, or I just think about it as like the average is $46,000. But what actually we're spending was $50,000 if we were to use the standard prices. So we spent more than the standard quantity was estimating there. So the variance would be $4,000 unfavorable, which means we have a spending variance, the difference between the materials price variance and the quantity variance, of $1,000. You also can look at the spending variance as the difference between the actual and the standard over here, or you can look at it as the difference between the two, if that makes sense, between the two different variances. All right, so that's question 1. Here are alternative formulas that you can use. A little bit simpler, but it's harder to track the flow of the data. I like this upside down triangle method better because it allows me to really understand what's happening to each dollar and why those variances even exist. But these are a little bit easier formulas down here. So now to question 2, compute the labor rate and efficiency variances for the month. We can look at the solution here. So very similar setup to that last question where You start in this upside down triangle view here where you have the actual times actual rate, and in the middle you have the actual times the standard rate, and then on the right you have the standard hours times the standard rate. And so we can compare those numbers, again, given to us in the problem, and that gives us, well, we know the actual amount was given to us in the problem of 14,925, so we don't need to do any math for that one right there. But we would have to do the math for the actual hours times the standard rate and the standard hours times the standard rate. But pretty simple math here, same exact steps as I outlined in the in the solution to number 1. And that gives us our labor rate variance, the difference between the actual and the actual times the standard. So that is a labor rate variance of 1425, and that's going to be unfavorable as our actual hours cost more than at the standard rate. And our labor efficiency variance is going to be $900. That's favorable, and that's because our actual amount was less than the standard amount. So that gives us a spending variance, or the difference between the two, of $525. Alternatively, there are some additional formulas here that can be used, but again, in my opinion, these are a little bit harder to understand the question conceptually with. But to each their own, definitely useful, definitely a quicker method, I would say, of solving the problem. Moving into Chapter 11, we'll be looking at 2 conceptual questions and 1 calculation. Starting with the 2 conceptual questions, 11-3 and 11-4. 11-3, distinguish between a cost center, profit center, and an investment center. And 11-4, what are margin and turnover? These are all concepts you will be seeing on the exam, so knowing the definition for all these is very important, as it'll help you not only get the right answer, but just be more efficient in answering all of your questions on the exam. All right, so we'll get into 11-3. So the answer for the difference between a cost center, profit center, and investment center, the manager of a cost center has control over cost, but not revenue or use of investment funds. A profit center manager has control over both cost and revenue. And an investment center manager has control over cost and revenue and the use of investment funds. So they think about the difference between the three is that they kind of build on each other in terms of what the managers can do. So in the first one, the manager of a cost center only has control over the cost. Then the profit center, they have control over the cost and revenue. And then finally, investment center, it's control over cost and revenue and the use of investment funds. 11-4, what are margin and turnover? The margin is the ratio of net operating income to total sales. So it's important. I would definitely have that formula written down. And turnover is the ratio of total sales to average operating assets. The product of the two numbers is the ROI. So I would also have the formula for ROI written down, and we'll be looking more at ROI in our next question. 11-8, exercise 11-8. The selected operating data for the two divisions of Outback Brewing of Australia are given below. So we have two divisions of this company, Queensland and New South Wales. Given to us are the sales, the average operating assets, the net operating income, and the property, plant, and equipment net. And we can see those for the two divisions. Now, what are we required to do? We're required to compute each division's margin, turnover, and return on investment, and then answer the question, which divisional manager is doing the better job and why? So hopefully you wrote down those formulas in the last question, as we'll directly be using them in this question. So starting with the calculation for ROI, well, I guess margin, turnover, and ROI for Queensland and New South Wales. We have the computations up here. So as you know, ROI, the formula for ROI is margin times turnover. So here's the individual formulas for margin and turnover. So for the Queensland's division, we have ROI is equal to the margin, which is going to be $360,000 of net operating income divided by $4 million in sales times $4 million in sales divided by the $2 million in average operating assets. And so that gives you a margin of 9% and a turnover of 2. So that means our ROI is going to be 18%. In the New South Wales division, using the same exact formula, just plugging in the numbers from the right side of the table here, that gives us a margin of 6% and a turnover of 3.5, which means our ROI is 21%. Now, to answer the question, which divisional manager is doing the better job and why? The manager of the New South Wales division seems to be doing the better job. Although the New South Wales division margin is 3 percentage points lower than the margin of the Queensland division, 6% versus 9%, its turnover is higher, a turnover of 3.5 compared to the turnover of 2.0 for the Queensland division. The greater turnover more than offsets the larger margin or the lower margin, resulting in a 21% ROI as compared to an 18% ROI for the other division. So our New South Wales division, because it has the higher turnover, it's going to offset that lower margin and give us a total ROI higher. Now notice if you look at the margin alone, then the Queensland division appears to be the stronger division. This fact underscores the importance of looking at turnover as well at margin in evaluating performance in an investment center. So this is a good question, testing your ability to apply these pretty simple formulas in a conceptual sense and be able to derive a real answer out of what the numbers mean. It's one thing if you can just solve what the margin is of 9%, but it's another thing if you can fully break down that margin and understand why that makes X, Y, and Z stronger than a different division, for example. So this is a good problem to apply your knowledge of just the mathematics and using that to come up with the conceptual answer here. Chapter 12, we're going to be looking at 12-3 and 12-4 conceptual questions, and then moving on into an exercise question, testing out the calculation side of the concepts covered in 12-3 and 12-4. Starting with 12-3, we're going to be answering, what is the difference between delivery cycle time and throughput time? What 4 elements make up throughput time? What elements of throughput time are value added and what elements are non-value added? And then in 12-4, what does a manufacturing cycle efficiency, or MCE, of less than 1 mean? How would you interpret an MCE of 0.4? Okay, 12-3. The difference between delivery cycle time and throughput time is the waiting period between when an order is received and when production on the order is started. Throughput time is made up of process time, inspection time, move time, and queue time. Process time is the value added, and then inspection time, move time, and queue time are non-value added time. So I would definitely know that throughput time has 4 components to it, and of the 4 components, process time is value added time, and then the remaining 3, inspection time, move time, and queue time, are non-value added time. That's a good concept to review for the exam. And 12-4, what does a manufacturing cycle efficiency of less than 1 mean, and how would you interpret an MCE of 0.4? An MCE of less than 1 means that the production process includes non-value added time. An MCE of 0.4, for example, means that 40% of throughput time consists of actual processing, and the other 60% consists of moving, inspection, and other non-value added activities. Moving on into the exercise question, we're going to be applying the concepts we just reviewed in 12-3, 12-4 conceptual questions, and applying it now to this 12-3 exercise. So management of middle company wants to reduce the elapsed time from when a customer places an order to when it is shipped. It provided the following data for a recent quarter. So we're given the inspection time of 0.3 days, the wait time of 14 days, process time of 2.7 days, move time of 1 day, and queue time of 5 days. Now we're required to compute the throughput time, compute the manufacturing cycle efficiency for the quarter. We're going to have to calculate what percentage of the throughput time was spent in non-value added activities. We're going to compute the delivery cycle time. And finally, if using lean production eliminates all queue time, what will be the new MCE? So we can get started with looking at the throughput time. So as we know from the last conceptual questions, throughput time is the formula for throughput time is process time plus inspection time plus move time plus queue time. So it's as simple as just adding up those days that were given to us in that blue table on this chart here. Now the only thing that we have to remember is that wait time is not included in throughput time. So it's all the days excluding wait time. So it's going to be coming out to 9 days as our throughput time. Now we're going to compute the manufacturing cycle efficiency for the quarter. The manufacturing cycle efficiency, the formula is value added time divided by your total throughput time. And we know that throughput time is made up of value added time and non-value added time. The only the only time that is value added in the throughput time is the process time. Everything else is non-value added. So we're going to take pretty much our process time divided by our total throughput time. So it's going to be 2.7 days, that's our process time, divided by our total throughput time of 9 days. So it means our manufacturing cycle efficiency is 0.3. So again, to recap, throughput time is made up of value-added time and non-value-added time. And we know that in throughput time, the only value-added time is process time. So the formula for MCE is going to be in this problem is going to be our process time divided by our total throughput time. And that means 30% of our time is, the MCE is 0.3. Now moving on to question 3, what percentage of the throughput time was spent in non-value added activities? Well, I kind of just said that. If the MCE is 30%, then 30% of the throughput time was spent in value-added activities. Consequently, that means that 70% of the throughput time was spent in non-value-added activities. So it's just the remaining percent. 1 minus 30% is going to give you 70% in non-value-added. But if you want the formula for that, then technically it is inspection time plus move time plus queue time divided by your total throughput time, and that should give you 0.7. Now, delivery cycle time, question 4, we're computing the delivery cycle time. It's as simple as adding the wait time to our throughput time. So we skipped out on including the wait time when we first calculated the throughput time, but now to calculate the delivery cycle time, we're adding in the wait time. So it's going to be that 14 days wait time plus our 9 days of throughput time to give us 23 days. Finally, question 5, if using lean production eliminates all queue time, what will be the new MCE? So we pretty much just need to remove the queue time from our throughput time formula. So we know the throughput time then will drop to only 2.7 plus 0.3 plus 1, not including this 5 days because we're getting rid of the queue time. So it's just going to be a total throughput time of 4 days rather than 9 days because we're subtracting out the queue time. So then now we can calculate our MCE as our value-added time divided by our total throughput time. Our value-added time is the process time, which is 2.7 days, divided by our new 4 days of throughput time, and this gives us an MCE of 0.675. Thus, the MCE increases 67.5%. This exercise shows quite dramatically how lean production can improve the efficiency of operations and reduce throughput time. Chapter 13. We will be looking at 13.1 and 13.2 conceptual questions, and then moving forward into 13.4 exercise. Starting with 13.1, what is a relevant cost? And 13.2, define the following terms: incremental costs, opportunity cost, and sunk cost. So in Chapter 13, we're looking at all these different costs, whereas in Chapter 12, I'd say we're looking at the times. So it's important to know all your times and all your costs. I think it's a simple way of going about studying here, is knowing all the different kinds of the main topic of the chapters. But 13-1, what is a relevant cost? A relevant cost differs between the alternatives in a decision. So we'll be looking further at that and applying that definition conceptually in the next exercise that we do. And 13-2, define the following terms: incremental cost, opportunity cost, and sunk cost. An incremental cost or benefit is the change in costs or benefit that will result from some proposed action. An opportunity cost is the benefit lost or sacrificed when rejecting some course of action. A sunk cost has already been incurred and cannot be changed by any future decision. They all seem a little bit similar in definition, but definitely know the difference between all your different costs, because you will be asked about these and how to calculate these in the exam. So we'll move forward with 13-4. 13-4 exercise: Imperial Jewelers manufactures and sells a gold bracelet for $189.95. The company's accounting system says that the unit product cost for this bracelet is $149 even, as shown below. Direct materials $84, direct labor of $45, and manufacturing overhead of $20, making our unit product cost $149. A wedding party has approached Imperial Jewelers about buying 20 gold bracelets for the discounted price of $169.95 each. The wedding party would like the special filigree applied to the bracelets that would increase the direct materials cost per bracelet by $2. Imperial Jewelers would also have to buy a special tool for $250 to apply this special filigree to the bracelets. The special tool would have no other use once the special order is completed. To analyze the special order, Imperial Jewelers determined that most of its manufacturing overhead is fixed and unaffected by variations in how much jewelry is produced in any given period. However, $4 of the overhead is variable with respect to the number of bracelets produced. The company also believes in accepting this order. The company also believes accepting this order would have no effect on its ability to produce and sell jewelry to its other customers. Furthermore, the company would fulfill the wedding party's order using existing manufacturing capacity. So what are we required to do? We have to figure out what is the financial advantage or disadvantage of accepting the wedding party's special order, and then answer the question, should we accept the special order or not? So basically, to simplify this question, we're deciding if it's a good idea for Imperial Jewelers to go out of their way to do this special filigree request and buy this $250 special tool for these bracelets. We have to figure out if we're going to make a profit off of these bracelets, even at the discounted price, and including the special tool cost. So we can go through the problem now of how to calculate what is the financial advantage, or if we lose money, disadvantage of accepting the wedding party's special order. So only the incremental costs and benefits are relevant in this question. In particular, only the variable manufacturing overhead and the cost of the special tool are relevant overhead costs in this situation. The other manufacturing overhead costs are fixed and are not affected by the decision. So that's the example there of what is a relevant cost. It's only relevant to this specific situation in calculating the financial advantage. As, for example, the fixed cost wouldn't be relevant here because we're going to have to pay those anyway. So the only fixed cost we're going to be factoring in is the fixed cost of the purchase of the special tool, because that's relevant to this situation we're in, that we need to apply this special filigree to these bracelets. So we know that we're going to sell the bracelets at $169.95 per unit, which means the total for 20 bracelets is going to be $3,399. That's going to be our selling price that the customer would pay us. So now we need to figure out our incremental costs. We know our direct materials is $84 given to us. Then the direct labor is $45, again, given to us. The variable manufacturing overhead, we know that $4 of the $20 originally is variable. The rest is going to be fixed, and we don't have to consider that because that's not a relevant cost to this scenario. So it's only going to be the $4 for variable manufacturing. And then finally, the special filigree additional cost of $2 per unit is going to get added on, which means our variable cost per unit is $135. Now you multiply that across for the 20 bracelets. That brings our total variable cost to $2,700 for the order of 20 bracelets. So now we need to add in our relevant fixed cost, which is going to be the purchase of this special tool to apply this $2 special filigree. And that's going to be $250 for us, meaning our total incremental cost for accepting this job, this special order, is going to be $2,950. Now we have to calculate whether or not this is advantageous or disadvantageous for our company to do. And since our total incremental cost is lower than the incremental revenue from taking on this job, that means it's going to be an advantage. So there's going to be a financial advantage here. And it's just going to be the difference between the two. So we're going to make $3,399 by selling those 20 bracelets. And it's only going to cost us $2,950. So that means there's a financial advantage of accepting this special offer of $449. So now, should we accept this special order? Even though the price for the special order is below the company's regular price for such an item, the company would be better off accepting the order. This conclusion would not necessarily follow if the special order affected the regular selling price of bracelets or if it required the use of a constrained resource. But in this scenario, we did the math behind it. We figured out what were the relevant costs, and using those relevant costs, we're able to calculate our incremental costs and our total incremental cost off of that, compare that to our incremental revenue, and we were able to find the financial advantage and make that decision of whether or not it was a smart decision for the company to do. And that sums up Chapter 13, relevant costs, incremental costs, and I would take an additional look at opportunity costs and sunk costs in another problem. Okay, now we're going to move on to Chapter 14. We're going to be looking at Chapter 14, questions 14-2 and 14-3. 14-2, what is the time value of money? And 14-3, what is meant by discounting? I'll give you a few seconds to pause and think about the questions yourself. All right, 14-2. The time value of money recognizes a dollar received today is more valuable than a dollar received in the future because a dollar received today can be invested to yield more than a dollar in the future. 14-3. What is meant by discounting? Discounting is the process of computing the present value of a future cash flow. Discounting gives recognition to the time value of money, and it makes possible to meaningfully add together cash flows occurring at different times. We're going to be applying both of these concepts in the next exercise question. Moving on to that exercise, we're going to be looking at 14-7 in the book. Parent Industries has $100,000 to invest in one of the following two projects. You have Project A and Project B in this problem. You can see the cost of equipment required, the working capital investment required, the annual cash flows, the salvage value of equipment in 6 years, and finally the life of the project for both Project A and Project B. Additionally, the working capital needed for Project B will be released at the end of 6 years for investment elsewhere. Parent Industries' discount rate is 14%. So it's important to take note of that discount rate here because we're going to have to discount and find the present value of our cash flows in order to figure out what the net present value is for the total project. So what we're required to do here is compute the net present value of Project A and the net present value of Project B, and then make the decision which investment alternative would you recommend that the company accepts out of Project A and Project B. All right, so let's get started. We'll get into calculating the net present value of project A. So you can see here on the left side, you have the purchase of the equipment for $100,000. So it's going to be a negative cash flow here. And we know that we receive an annual cash inflow each year of $21,000. At the end of the 6 years, we have a salvage value of $8,000. And we've gotten all this data from the table here. Project A cost us $100,000, zero working capital required. We make a cash inflow of $21,000, and we have a salvage value of $8,000 at the end of the 6 years. So now we're going to have to discount this to get our net present value. So since we've spent the $100,000 right now, the net present value of the $100,000 is what we paid today. So it's going to be the full $100,000. Now we need to find the present value of our cash flows as well as the salvage value in 6 years. So we're going to use the PV tables given to you on the exam in order to do that. So on the PV table, we're going to go over and look at 14% on, I believe that would be like the x-axis of the PV table, and then go down each year. So year 1, discount the 21,000. Then year 2, year 3, year 4, year 5, and year 6. If you add up all those PV table values, it should be around 0.4. They'll sum for years 1 through 6 to 3.889, and you can use that as your discount factor to figure out how much that $21,000 is going to be worth in 6 years at a present value. That gives us a present value for the 6 years of 21,000 at 81,669, and that gives us a present value of the salvage value of $8,000 of $3,648. So we can add all three of those together: what we spent today, the present value of our future cash flows, and the present value of the future salvage value. And that gives us a net present value of $14,683. Now we can move on to project B. It's going to be a very similar process because we need to discount everything. So we have our working capital invested of $100,000, annual cash inflows of $16,000, and working capital released of $100,000 in year 6. So our total cash flows for year 0, or today, it's going to be $100,000. Present value is going to be, the discount factor is going to be 1 because it's today. So $100,000. Then years 1 through 6, again, we discount the annual $16,000 inflow, and we get a present value of $62,224. And finally, we need to discount the final working capital that's released in year 6, and we'll discount that with the year 6 14% discount factor of 0.456. And that gives us a present value of $45,600, meaning our net present value is positive of $7,824. So now the final question: which project should we invest in? Well, the $100,000 should be invested in Project B rather than Project A, as Project B has the positive net present value, whereas Project A has a negative net present value. Just a general rule: companies should always invest in a project if the NPV is positive. Even if it's a very small positive, it still is positive, so it's going to be a good idea to invest. If it's negative, obviously not going to want to do that compared to a project where you could make $8,000 here in net present value. So that's chapter 14, applying the concepts of time value of money and discounting into an exercise. Now we can move to chapter 16. We're going to be looking just at one question. We're going to be looking at one question and then one exercise. So the first question is 16-1, distinguish between horizontal and vertical analysis. To answer that, horizontal analysis examines how a particular item on a financial statement, such as sales or cost of goods sold, behaves over time. Vertical analysis involves analysis of items on an income statement or balance sheet for a single period. So take note of that single period for vertical analysis. In vertical analysis of the income statement, all items are typically stated as a percentage of sales. In vertical analysis of the balance sheet, all items are typically stated as a percentage of total assets. So know those key facts about vertical analysis, know the difference between horizontal analysis and vertical analysis, as I would expect there could be an exam question asking between the difference of the two or asking you about individually one of the two. And both the terms to me seem a little bit scary, and you don't want to get lost in what's not too complicated of a concept, just sounds a little bit more complicated. But that's the difference between horizontal analysis and vertical analysis. We'll move on to the final exercise of the exam review. We're going to be looking at 16-8. I apologize for how the slide is laid out, but there was a lot of information I had to include on here. So we've got our two blue tables here of data. It's the financial statements for this company, Castile Products. And we're going to be calculating the financial data and ratios over here that are required. So we're looking at working capital, current ratio, acid test ratio, debt to equity ratio, times interest earned ratio, average collection period, average sale period, and operating cycle. Additionally, it's important to note from these financial statements, the account balances at the beginning of the year were accounts receivable, $25,000, and inventory, $60,000. All sales were on account. And you can pause the video and go through all of these numbers here. I'll skip over reading through these numbers as that'd be a little too take too much time to read through all those. All right. So answers 1 through 5. We're going to be looking at working capital, current ratio, acid test ratio, debt to equity ratio, and times interest earned ratio. So the calculation of working capital. Working capital is the difference between your current assets and your current liabilities. So pretty simple formula there. You take the current assets, you subtract out your current liabilities, and you get your working capital. And you can find that on the balance sheet. So you should have total current assets over here, and you should have current liabilities over here of $50,000, and that's where we get our working capital of $65,000. Now, to answer what the current ratio is. Current ratio is similar to the formula for working capital. It's going to be current assets divided by current liabilities this time. So make sure you know the difference between the two. And the current ratio for this one is going to be 2.3 as we divide 115,000 by 50,000. Now moving on to the acid test ratio. The formula for the acid test ratio is going to be cash plus marketable securities plus your accounts receivable divided by your current liabilities. So we're given all those values in our table. Once again, we can add our $6,500 in cash. We have $0 in marketable securities, and we have accounts receivable of $35,000. And you can find that again on your balance sheet. So you have cash. Your accounts receivable is right beneath it. Or sorry, right. The beginning, you gotta factor in the beginning balance for the accounts receivable. So we're gonna add in the additional $25,000 here, and that should give us our acid test ratio divided by current liabilities. All right, moving to the debt to equity ratio. It's going to be total liabilities divided by our total stockholders' equity. So our total liabilities given to us is $130,000, and our total stockholders' equity is $170,000. So that gives us a rounded debt to equity ratio of 0.76. Now for the final one of answers 1 through 5, we're going to look at the times interest earned. So this is going to be EBIT, earnings before interest and income taxes, divided by your interest expense. So your EBIT is going to be $38,000 divided by $8,000. All right. So you can see over here, your net operating income over here is going to be $8,000 or $38,000. Sorry, and your interest expense is given to you in the income statement, $8,000. So none of these questions are too challenging, I would say. It's just simply plug and chug with the definitions, or sorry, not the formulas for these terms, but it is important to know all of these formulas. You don't want to get lost on an easy question on the exam where it's simply asking you to divide current assets by current liabilities, but you don't know what that is. And additionally, I would understand what each of these ratio actually mean. It's one thing to have a current ratio of 2.3, but it's another thing to be able to articulate what 2.3 actually means in a current ratio. So I would independently go through and review all of these terms, these ratios that you can calculate, and actually understand the meaning behind the result you can get. With that, we'll keep moving on to the average collection period, the average sale period, and the operating cycle. Average collection period. So we're going to need to calculate first our accounts receivable turnover. So the formula for that is going to be sales on account divided by your average accounts receivable. And so we know that the beginning balance was $25,000, the ending balance was $35,000. So we can add those together and get our average of, and divide that by 2. I forget if I said that, and get our average. And then our sales on account is going to be $420,000. And so that gives us a turnover of 14. Now the average collection period is going to be 365 divided by that turnover. So you have 365 days divided by the 14 turnover, and that gives you an average collection period of 26.1 days. Now to calculate our average sale period, it's going to be similar, but this time we're going to be using inventory turnover rather than accounts receivable turnover. So we're going to be dividing cost of goods sold by your average inventory to get your inventory turnover, and your inventory turnover in this problem comes out to 4.5. Again, you want to find the average inventory by adding your 60,000 and 70,000, and then dividing that by 2 to get the average over the time period. And so your average sale period, you're going to take 1 year and divide it by that inventory turnover of 4.5, and you get 81.11 days. Finally, the operating cycle is computed as following. So the operating cycle is going to be your average sale period plus your average collection period. Now we just calculated both of those in the last 2 steps. So that gives us a total operating cycle of 107 days. This is a good example of understanding how the formulas are all broken down. You may understand that the operating cycle is the average sale period plus the average collection period, but definitely make sure for the exam that you know what are the components of the average sale period. You need to be able to calculate inventory turnover first, and then average collection period, same thing. You need to find your accounts receivable turnover and then be able to divide 365 by those turnovers. That's all I have. Thank you for tuning in to the exam review session for the final for Accounting 404.